joined by Mr. Sunil Subramanian, and on the technicals, Aditya Arora is joining us. Both of you gentlemen, welcome to the show and thanks for your time today. Sunil sir, let's begin with you. Your view and your outlook for 2026, given that this year has been full of surprises. What are you penciling in for the equity market moves next year?
So I think the equity markets on a broad basis should deliver double-digit returns next year, which is a very big contrast because you had large caps probably deliver high single-digit and mid caps much lesser and small caps actually negative. So I think we're going to see a reversal of that. And while large caps will continue to provide stability of, let's say, 11 to 12% returns, I think that the mid caps and small caps are going to outperform the large caps in the coming year. I think that's one take from me. The second is, of course, is that the scale of this outperformance depends on the trade deal happening. I think that this kind of a level of outperformance can happen even without trade deal really happening. But if the trade deal happens, I expect FII flows to return in a big way, and that could give a major boost to the export-oriented sectors. So I think that's the thing. Otherwise, the domestic sectors around discretionary consumption and to some extent capital goods, I think will drive the story for next year. And if the trade deal happens, then exports-oriented sectors could get a big pickup. So there's a big, I would say, digital thing around the trade deal. As you know, we've been expecting it for so long. Keeps coming, coming, coming. So when will it come? We still don't know. But it will happen one day in the next 365 days. I think I carry that kind of an optimism that it will crack one day. And when that happens, you will see the external export-oriented sectors also pick up, and that will boost the market return significantly.
That's quite interesting you say that, Sunil. But wondering what sectors do you think are going to lead those kind of returns in the next year?
So I think that, see, the GST impact actually came through in the last quarter and was largely centered around the auto space as both as a market as well as in the sales front. But I think the real impact of the GST will be felt in the broader discretionary consumption pack through the whole of 2026. It'll start off with auto sales being strong in the first quarter because of the depreciation that you get when you buy a car or a thing before the end of March. So the auto will get a boost there. Then in the summer, you will get your cooling related durables like refrigerators, air conditioners, coolers. Those will get a pickup which will last right through June. And I think that finally the real estate sector will get its act together because this year it's been the worst performing. If you compare to the Nifty, realty has been the worst performing. But I think that there's a hidden story there that the reason why the GST cuts on cement, steel, and all those supporting the housing, the RBI cuts of 125 basis points, all of that still hasn't made its presence felt in the reality because I think that the corporate sector realty has been focused on the, I would say, larger houses, the villas, the premium housing. I think the other housing is the big story for next year. And I think that supply has been an issue. Developers haven't just built it because there was no demand. They also did not go and launch these kind of projects. But I think with all of these favorable factors coming through in the next year, you will see a lot of supply in the affordable homes and also a buying demand. So I think realty will get a pickup because on top of this, you have the GCC story also continuing, which is positive for realty, and the fact that REITs, a key source of financing for the realtors, has now got equity status. So I expect mutual funds to allocate more money to REITs now, and which will give a very good source of funding. So I'm very bullish on the realty space. So I consider all of this as within the broader discretionary space. So there's auto, there's other consumer durables, and there's realty. So that's one strong story. The other story is that the GST cut will definitely lead to a growth in revenues. Now, whether they get margins improve or don't improve, we'll know in the earnings season. But top lines are going to grow, and which means that capacity utilization in the country is going to rise. And I expect it to cross that 80% magical mark this year. When that happens, private capex will get a pickup. Now, that may not be in the first half of the year, maybe the second half, but I think capital goods, especially engineering-oriented capital goods, I think are a very good play for starting the investing process in the next year. And finally, I would say that the whole thing rests with the banking system in terms of funding. So whether it's real estate, whether it's consumer durables, or it's capital goods, financing is a very key. And I think that the whole banking sector, NBFCs, private banks, and more importantly, public sector banks are going to lead that. Credit growth is going to outpace deposit growth. So there's going to be good margins for banks, especially PSU banks, which focus a lot on the SME and MSME, which are the actual executors of capex expansion. So I think that for me, the banking, I know the sector has done very well last year. PSU banks have delivered what, 24% 1 year return. But I think the story is good enough for the next 2 to 3 years. And so I would say banking and financial services carries a safety element today because the valuations are already there. The prices have already risen, but they will still continue their credit growth story through the whole of next year. And since they are an important part of your portfolio.
Okay, sounding very optimistic over there, Sunil sir. It's the banking and financial names, consumer durables, as well as real estate, where the conviction is lying right now. We also have Aditya Arora, who's joined us on the technicals, founder and multi-asset research analyst at aglytic.in. Aditya, hi, good afternoon, and thank you for your time. Shifting focus from some of the top performers this year, let's talk about Pharma. On the year-to-date basis, roughly a 3% cut on the Nifty Pharma index. Yes, we've had a lot of news around tariffs, a lot of positive news also around the exemptions and tariffs. But on the charts, give us a sense of how the Nifty Pharma is shaping up and any stocks that you're liking from the Pharma basket.
Very good afternoon to you and to all our viewers. I think Nifty Pharma, although we saw a lot of volatility and a lot of bad news also when there were a lot of tariff news, this sector went through a correction, but didn't give up. We have seen a strong bounce back in this sector, and we are still trading at around swing highs. So that shows the strength of the sector, and I'm pretty optimistic on this sector given the strong chart patterns over here. Currently, Nifty Pharma is trading at 22,600. One can expect targets of about 23,500 to 24,000. And Abort seems a good candidate in pharma sector. Today also it's up about 1.5%. Currently trading at 28,900. One can keep a stop loss over here at 27,500 and targets of about 30,000 to 31,000.
Okay, that's quite interesting. Those are, of course, some of the key sectors and how the charts have been reading. We'll take a very quick break, come right back. We'll continue tracking markets and the last lap of this trading week on the other side.
in association with Bank of Baroda.
As well as Sunil Subramanian. Just taking stock of where the market is settling in at for the week, while of course through the year it's been outperformance from the Nifty and then came mid-caps, while negative returns from the small cap at an index level. Today of course it's Coforge, Nuvama seeing some profit taking, Dixon has been down, HFCL etc. have been lagging, but it's the entire infra space led by railways which is actually leading today. RVNL up 11.5%, IRFC, Titagarh up 5.5%, IRCTC up 4%, and then of course there's NBCC as well after them announcing their foray into the Dubai geography. That's holding up about almost 5% as well as we speak. Aditya, any of these charts, RVNL, IRFC, Titagarh, IRCTC, where is it that you see follow through uptick?
I think you have picked a very good sector given that we have a budget coming up in 2 months, and the momentum has started since 2 days, and these stocks have been trading at almost swing lows or 52-week lows, almost a correction of about 1 year, and there was no action in these counters. But when the market is overall sluggish and sideways, these stocks have shown very strong momentum and with very strong volumes. So I see institutional accumulation in these counters. And one of the stock, although I like the complete sector and I think the steam is still left, the sector could continue its uptrend. One of the stock which just started the rally is IRCTC. This stock has took a lot of time to consolidate and it has been in correction since May 2024. So this week has been a very strong week given that we are on Friday and closing of this week will come. So this is a bullish candidate at 706 and one must keep stop loss at 660 and target should be 750 to 800. RVNL is also very good candidate. Today it's up about 12% and it's a buy at 387. One must keep stop loss at 317 and target should be 450 to 500. So the whole sector, railway sector looks pretty good and there's bullish momentum over here.
Oh, yeah, it sure is. And it's pretty much lasted all through this week. But let's take a step back and analyzing earlier. Railways, defense, the concern always has been about valuation over here. Do you sense, railways have seen enough correction and this new wave of an uptick that you're seeing in railway names, do you sense this could be bought into?
No, I think it's more of a budget trade.
Okay.
I think they're expecting big announcements around the railway in the budget. And I also think the operators are building up the railways for that. Well, I think the correction is not fully done. So once the budget comes through, it depends on budget lives up to the railway expectations, then it could sustain for some time. But if it doesn't, then they could correct back again. So I think railways is clearly a tactical play centered on the budget. So I wouldn't hazard a medium-term view yet on that till I wait for the budget and view. On defense, I have a different story. I think that the story is very strong. And I think that when you look at the defense, right, you're mostly like the PSU stocks dominate the defense index and people look at that. But I think the potential for growth lies in the private sector defense with all the modernization of this, the result of the Atmanirbhar Bharat, the drones, the UAVs and all of that. So I think that the longer story is the private sector new age defense story, which I would still buy into from a medium term perspective. Of course, the budget also will have an allocation to defense, which will decide the way the PSU sector operates. But overall, I'm a believer that defense is a long-term hold, whereas railways, it's very tactical play.
Quite interesting. That's the take coming in right now on railways, because that seems like more of a tactical trade just ahead of the budget, whereas defense, of course, is a lot more meatier move as we speak right now. Just looking at some of the other stocks and where is it exactly that you are seeing some traction build in. And one is seeing a decent move come by, not just for railway names, but look at an NBCC, for instance. That as well is looking pretty strong. That, of course, had a fundamental trigger as well attached to it, given that NBCC has now entered the Dubai real estate market with almost a 15 million dirham land buy. And they've signed an MOU with Mumbai Port as well for a CGO complex. So that's the move that's aiding this particular stock. Sunil, do you sense that Infra as well could have a budget kicker perhaps attached to it, or does it seem like a more long-term story?
I think it's more like a more long-term story because in the budget, I think this time the government will keep infra flat in terms of the capital goods side and will still focus on giving money back to the people in the form of tax cuts and other giveaways. Because I think that's worked last year. The government will stick to that now as a plan because they realize that ultimately private consumption has to pick up for private capex to pick up. So whatever amount government allocates to infra, that's only part of the story. Private capex has to come to the party. So I would see in the budget government trying to incentivize that either by boosting capacity utilization, giving more money in the hands of people to go and spend, as well as to maybe do public-private partnerships with the private sector and public sector so that private sector can participate in the capex resolution. So I think the budget will try and take the burden of capex partly from the government, but partly will try and get the private sector to participate. So while the budget could give a lot of incentives towards this, maybe a remodeled PLI scheme and all of that, but government's own spending, I think, will be probably around the 10 to 11 lakh crore flattish year on year. Because remember, this budget, we still have to wait and see what the GST cut impact on the revenues of the government have been. So how much has the government got room to spend more on capex? We'll have to wait and see. So I would go back for a flattish capex growth, continuing the focus, but divert more money towards consumption and to private capex.
Aditya, what's your reading on the charts of the defense names, though? They've sprung up very, very, well. And of course, throw in Infra as well there, led by NBCC today. What's the chart telling you?
Absolutely. I think NBCC is a very good pick right now, given that since last October, this stock is seeing very high surge in volumes, and that is accompanied by a good breakout today. Today also, we are seeing 10 times the average volume. This shows that there's good accumulation going on this counter. And now we are trading at 52-week high, given the markets are also sluggish. That shows relative strength. I see this stock moving up towards levels like 140 to 160. One should place stop loss at 112.
So that's the take on BEL. In fact, the other stock that's doing really well is Dilip Bilkon. While we're talking about some names from the infra space, Dilip Bilkon is doing well today, 2.25% up. The longer term chart for Dilip Bilkon, while the stock is doing really well today, want to see what the stock has done in the last 6 months, 1 year. What is your reading on the charts?
Yes, I think Dilip Incol has been more or less in a consolidation since a very long time. Currently, the action lags, the strong bullish momentum is lacking. We'll wait for a breakout if the stock breaks above its strong multi-week, multi-month resistance of 575. If the stock moves above this level, then one can turn bullish on this counter for targets of 650 to 750, and one should place stop loss at 525.
Right, okay, that's Dilip Biltcon. While in the last 6 months, that stock has lagged about almost 7% and hasn't done a whole lot through this year, barring a few patchy performances during September when it did perk up. But now it seems like because of the order inflows, it's beginning to perk up once again. But Sunil, to your premise of what the budget will entail, do you sense then, basis that one should have a heavier allocation perhaps to consumption names and discretionary spends?
Yes, absolutely agree. Because I think that the government will continue the journey of this GST cut, rate cut, income tax cut story. They'll liberalize it more because I think they've realized that, and some big elections coming up next year. So they've realized that money in the hands of the people is very powerful. It's helped them this year sweep the elections, right? So I think that they've realized, and I would like to coin this as something called developmental populism, because it's populism which puts money in the hands but then gets spent in the economy, and hence it'll boost development through consumption related growth in the economy, and following that private capex growth. So I think that yes, I distinctly expect that this will be a consumer oriented budget more than a capex oriented budget. That being saying, that's more at the margins, right? I think they'll keep the capital expenditure flat year on year, or maybe a marginal growth. But the focus will be, I believe, on consumption.
Sunil sir, in your previous answer, you did very briefly mention a tax cut. Is that something you're expecting to see from the budget this time around as well, given the cut that was already announced this year?
So I think that the government has started believing that if you rationalize these taxes and push more people into the new tax regime, right, then they are saving a lot in terms of the cost of the older tax regime, right, in terms of the national savings certificate, or high borrowing costs for the government. So government has been trying to push it away from that so that they don't end up paying those high interest rates. So I think that is a process which will gradually continue. So I do expect that at the margin, they will announce some more relaxations around the taxation regime.
Right, okay. That's the take coming in on what the budget anticipation is going to be. Aditya, what's your own reading on the charts though? Anything from the FMCG or the consumption basket? I mean, we've been flagging off the way Titan, for instance, has spurt up today and how they're getting into the mid-luxury or rather mid-mass segment now. With the launch and foray into Beyond as well and lab-grown diamonds, that Asian Paints, Indian Hotels, what is it within consumption that you're liking?
Right. So I will agree with Sunilji that around the budget, we see a good jump in a lot of consumption names. Even last time, I think it was only the FMCG sector which did well, whereas other stocks were lagging. So this time the same patterns could repeat. There's some seasonality in chart of FMCG counter wherein they see good buzz around the budget time. So my pick is ITC Hotels. This stock is a new candidate, newly listed stock, and recently it's bouncing off from its important support levels. So this one looks good at 200 odd levels. One should keep stop loss at 180 and target should be 220 to 240. And even FMCG basket looks pretty good. This particular basket did well in the last budget, and I think this time around also we could see a good spurt in FMCG space. In that space, I like Marico. This stock has been doing pretty well, trading at 52-week high, and there's constant accumulation seen in this counter, and always respecting the support. Whereas other FMCG counters have done not so good, but this one has done pretty well, and it's ready for a breakout. So this is a bullish candidate at 743. One should keep stop loss at 690, and target should be 792.
Has been a theme that's played out. It started to play out this year. Let's see if that rally continues next year as well. But on that note, Sunil and Aditya, thank you so much for your time today. We'll let you go. But let's start winding down for the day, for the week. Tell you what has happened in the market ever since the get-go today. Nifty absolutely flat, slightly under pressure. But yes, we've managed to at least hold on to that 26,000 mark for the Nifty, and we're going to be ending the week absolutely